Question 1, scenario based. Mr. Adamson is a newly licensed insurance agent in Virginia. He has a meeting with a potential client who asks him to recommend a specific life insurance policy. The client mentions that he has been approached by other agents offering similar policies. Mr. Adamson feels pressure to make a sale quickly and decides to highlight only the benefits of the policy while avoiding any mention of the potential risk. Limitations. Which of the following actions should Mr. Adamson have taken to comply with Virginia's insurance regulations on ethical sales practices? A. Explain only the benefits of the policy, as clients are primarily concerned with positive outcomes. B. Provide the client with a balanced overview, including both the policy's benefits and limitations, to ensure informed decision-making. C. Encourage the client to switch to his policy without discussing the pros and cons of the existing policy. D. Avoid discussing any competing policies offered by other agents to avoid conflict. Answer. B. Explanation. Virginia insurance regulations require agents to act in the best interest of their clients by ensuring full disclosure during the sales process, and Mr. Adamson should provide a balanced overview of the policy, including both benefits and limitations, to ensure the client can make an informed decision. Highlighting only the benefits may be considered misrepresentation, which is prohibited under Virginia's Unfair Trade Act. Additionally, twisting or persuading client to switch policies without valid reason is illegal in Virginia. Question 2. Which of the following best describes the purpose of the Virginia Life Accident and Sickness Insurance Guarantee Association? A. To provide financial assistance to insurance companies in times of financial distress. B. To protect policyholders from insolvent insurance companies by covering claims up to certain limits. C. To set the minimum premium rates for life insurance policies in Virginia. D. To issue new licenses for insurance agents operating in Virginia. Answer. B. Explanation. The Virginia Life Accident and Sickness Insurance Guarantee Association is designed to protect policyholders if an insurance company becomes insolvent. It ensures that policyholders' claims are paid up to certain limits set by law. This association is a safety net for consumers, ensuring that they are not left without coverage due to an insurer's financial failure. Options A, C, and D are incorrect because they describe roles that are not within the scope of the Guarantee Association. Question 3. In Virginia, which of the following is a key responsibility of an insurance agent regarding fiduciary duty? A. Keeping all commissions earned without any obligation to disclose them to the insured. B. Depositing collected premiums into the agent's personal account before remitting to the insurer. C. Holding premiums collected from policyholders in a separate trust account before transferring them to the insurer. D. Offering financial advice to clients on investments unrelated to insurance policies. Answer. C. Explanation. Insurance agents in Virginia are required to maintain fiduciary responsibility when handling clients' funds. This means they must act in the best interest of the client and insurer by keeping premiums in separate trust account before remitting them to the insurer. Mixing client funds with personal funds is considered breach of fiduciary duty and can result in disciplinary actions. Options A, B, and D are incorrect because they involve actions that either violate fiduciary rules or fall outside the scope of an insurance agent's responsibilities. Question 4, scenario-based. Ms. Thompson owns a bakery in Virginia and is seeking a commercial property insurance policy. She informs her agent, Mr. Benson, that she wants the cheapest coverage available, even if it means fewer protections. After some discussion, Mr. Benson advises her to lower her coverage limits to reduce premiums. A month later, a fire causes significant damage to the bakery, and Ms. Thompson discovers her policy does not cover the full cost of repairs. Who is responsible for the inadequate coverage here? Ms. Thompson, because she requested cheaper coverage. B. Mr. Benson, because he has a duty to ensure that clients are aware of potential coverage gaps. C. The insurance company, because it issued the policy. D. Both Ms. Thompson and Mr. Benson equally share responsibility. Answer. B. Explanation. In Virginia, insurance agents have a fiduciary duty to provide clients with adequate advice and ensure they understand their policy's limitations. Advising a client to lower coverage limits without fully explaining the risks can be seen as negligent advice. Mr. Benson should have clearly communicated the potential consequences of inadequate coverage. This case touches on errors and omissions. Liability for agents would result in legal consequences if an agent fails to properly advise a client. Question 5. Which of the following statements about Virginia's Unfair Trade Practices Act is correct? A. It allows insurers to deny coverage based on an applicant's race or national origin. B. It prohibits agents from using misleading advertising to induce policyholders to buy insurance. C. It requires insurers to offer the same premiums to all applicants, regardless of their risk profile. D. It allows agents to pay undisclosed commissions to third parties who refer clients. Answer: B. Explanation. Virginia's Unfair Trade Practices Act prohibits various unethical behaviors, including misleading advertising, false statements about policies, and twisting. Option is incorrect because discrimination based on race or national origin is illegal. Option C is incorrect because insurers can charge different premiums based on an applicant's risk profile. Option D is incorrect because undisclosed commissions are considered unethical and can lead to disciplinary action. Question 6. In Virginia, which of the following is not a valid reason for an insurance company to cancel a property insurance policy after it has been in effect for 60 days? A. Discovery of a material misrepresentation in the application. B. Non-payment of premiums. C. A significant increase in the insured property's value. D. Discovery that the insured property is being used for illegal activities. Answer: C. Explanation. Under Virginia law, an insurance company can cancel a policy after it has been in effect for 60 days for specific reasons such as material misrepresentation, non-payment of premiums, or discovery of illegal activities at the insured property. However, an increase in the insured property's value is not a valid reason for cancellation. Insurers may adjust the premium based on value changes but cannot cancel policy for this reason. Question 7, scenario-based. Mr. Rodriguez is applying for a homeowner's insurance policy in Virginia. During the application process, he mentions that he occasionally runs small bakery business from his home. His agent, Ms. Lynn, assures him that his homeowner's policy will cover any incidents related to his business. 6 months later, customer visiting the home bakery slips and falls, resulting in lawsuit. The claim is denied by the insurer. Could Ms. Lynn have done differently to avoid this situation? A. Advised Mr. Rodriguez to increase the liability limits on his homeowner's policy. B. Recommended commercial liability policy to cover business activities. C. Applied for separate umbrella policy to cover potential lawsuits. D. Not mentioned the home-based business to the insurer to keep premiums low. Answer: B. Explanation. In Virginia, homeowners insurance policies typically exclude coverage for business activities conducted on residential property. Ms. Lynn should have recommended commercial liability policy to cover business-related risks. Option is incorrect because increasing liability limits on homeowners policy would not cover business claims. Option C is not the best solution because an umbrella policy would also likely exclude business-related claims. Option D is unethical and would constitute misrepresentation, which is violation of state insurance laws. Question 8. Which of the following best defines an admitted insurer in Virginia? A. An insurer that is approved by the Virginia State Corporation Commission to conduct business in the state. B. An insurer that only offers life and health policies to Virginia residents. C. An insurer that provides coverage exclusively to high-risk applicants. D. An insurer that is headquartered outside of Virginia but does business in the state. Answer A. Explanation. An admitted insurer is a company that is licensed and approved by the Virginia State Corporation Commission to offer insurance policies within the state. These insurers must comply with Virginia's insurance regulations and are backed by the Virginia Life, Accident, and Sickness Insurance Guarantee Association. Option B is incorrect because admitted insurers offer various types of coverage, not just life and health. Option C is incorrect because high-risk applicants are typically covered by non-admitted insurers. Option D refers to foreign insurers, which can be admitted if licensed in Virginia. Question 9. In Virginia, which of the following is an example of rebasing, which is prohibited by state law? A. Offering client-free consultation to review their current insurance coverage. B. Providing client with discount on their premium in exchange for purchasing multiple policies. C. Offering prospective client $100 gift card as an incentive to purchase policy. D. Reducing an existing client's premium after policyholder reports safe driving record. Answer C. Explanation. Rebating is the practice of offering money, gifts, or other valuable incentives to induce someone to purchase an insurance policy. This is prohibited under Virginia law to ensure fair competition and prevent unethical sales practices. Option is allowed as it is a common business practice. Option B is not considered rebating because multi-policy discounts are approved by insurers. Option D is incorrect because safe driving discounts are based on underwriting criteria and are not considered rebating. Question 10. Which of the following scenarios could result in disciplinary action against an insurance agent in Virginia? A. The agent fails to report a change in address within 30 days. B. The agent fails to send a holiday card to all clients. C. The agent cancels a policyholder's coverage without notifying the insurer. D. The agent refuses to meet with a client outside of business hours. Answer A. Explanation. Virginia law requires insurance agents to report any changes in address or name to the State Corporation Commission within 30 days. Failure to do so can result in disciplinary action, including fines or license suspension. Option B is irrelevant, as holiday cards are not a regulatory requirement. Option C is incorrect, because only insurers, not agents, can cancel a policy. Option D is also incorrect, as agents are not required to meet clients outside of their regular business hours. Question 11. Which of the following is required under Virginia law for a valid cancellation notice for an auto insurance policy? A. The notice must be sent via certified mail only. B. The notice must include the reason for cancellation and be sent at least 45 days in advance. C. The notice must provide a refund of any unearned premiums immediately upon cancellation. D. The notice must be delivered in person by the insurer. Answer B. Explanation. Under Virginia law, an insurer must provide written notice to the policyholder at least 45 days before cancellation for reasons other than non-payment of premiums. The notice must clearly state the reason for cancellation. Certified mail is not required unless specified, making option incorrect. Question 12. What is the purpose of Virginia's Property and Casualty Insurance Guarantee Association? A. To regulate premium rates for property and casualty policies. B. To pay claims of insolvent insurers up to certain limit. C. To prevent insurers from offering policies to high-risk clients. D. To provide legal representation for policyholders in disputes with insurers. Answer B. Explanation. The Virginia Property and Casualty Insurance Guarantee Association protects policyholders and claimants by covering claims up to a specific limit if their insurer becomes insolvent. Its purpose is to ensure the stability of the insurance market. Question 13. Under Virginia law, how long must an insurer retain records of policy transactions? A. 3 years. B. 5 years. C. 7 years. D. 10 years. Answer B. Explanation. Virginia requires insurers to retain records of policy transactions for a minimum of 5 years. This ensures proper documentation for audits, legal disputes, or regulatory reviews. Question 14. Scenario-based. An insurer in Virginia denies a homeowner's claim, stating that the damage is not covered under the policy's exclusions. The policyholder disputes this and files complaint with the State Corporation Commission (SEC). What is the SEC's role in this case? A. The SEC will revise the policy's terms to favor the policyholder. B. The SEC will mediate the dispute and issue binding resolution. C. The SEC will investigate the complaint to ensure the insurer acted within the law. D. The SEC will represent the policyholder in court. Answer C. Explanation. The State Corporation Commission (SEC) investigates complaints to ensure insurers comply with Virginia's insurance laws. It does not mediate disputes or revise policy terms. Question 15. Which of the following is an example of twisting under Virginia insurance law? A. Encouraging client to switch policies to save money without disclosing potential drawbacks. B. Advising client to increase their coverage limits for better protection. C. Offering policyholder discount for renewing their policy. D. Failing to report client's change of address to the insurer. Answer A. Explanation. Twisting involves misleading a client to replace an existing policy with a new one by making false or incomplete comparisons. This unethical practice is prohibited under Virginia law. Question 16. How does Virginia law define a domestic insurer? A. An insurer operating exclusively in Virginia. B. An insurer formed under the laws of Virginia. C. An insurer that provides coverage for Virginia residents only. D. An insurer headquartered in Virginia but operating nationwide. Answer B. Explanation. A domestic insurer is an insurance company incorporated under Virginia law. This does not restrict its operations to Virginia alone. Question 17. In Virginia, which of the following is a requirement for maintaining an insurance license? A. Completing at least 24 hours of continuing education every 2 years. B. Selling a minimum of 50 policies annually. C. Reporting client complaints within 10 days. D. Attending annual industry conferences. Answer A. Explanation. Virginia requires licensed insurance agents to complete 24 hours of continuing education every 2 years to maintain their licenses. Failure to do so may result in suspension or revocation. Question 18. What is the primary purpose of Virginia's financial responsibility law? A. To ensure all drivers have auto insurance. B. To regulate auto insurance premium rates. C. To provide legal representation for uninsured drivers. D. To guarantee compensation for victims of accidents caused by uninsured drivers. Answer A. Explanation. Virginia's financial responsibility law ensures that all drivers maintain adequate auto insurance coverage or meet other financial responsibility requirements. Question 19. Which type of coverage is mandatory for all auto insurance policies in Virginia? A. Collision coverage. B. Comprehensive coverage. C. Uninsured underinsured motorist coverage. D. Roadside assistance. Answer C. Explanation. Virginia requires auto insurance policies to include uninsured underinsured motorist coverage to protect policyholders in accidents involving drivers who lack adequate insurance. Question 20. What is the maximum penalty for willfully violating Virginia's insurance laws? A. $1,000 per violation. B. $5,000 per violation. C. $10,000 per violation. D. $25,000 per violation. Answer C. Explanation. The maximum penalty for willfully violating Virginia's insurance laws is $10,000 per violation. This serves as deterrent to unethical or illegal practices. Question 21. Which of the following best describes fiduciary duty in the context of insurance agents in Virginia? A. The obligation to prioritize the agent's commission over client needs. B. The responsibility to provide accurate and honest advice to clients. C. The requirement to report competitors engaging in unethical practices. D. The duty to sell as many policies as possible. Answer B. Explanation. A fiduciary duty means that an insurance agent must act in the best interest of their clients, providing honest and accurate advice while avoiding conflicts of interest. Question 22. In Virginia, what is the penalty for an agent failing to disclose their financial interest in a policy? A. License suspension. B. A fine of up to $500. C. A written warning. D. No penalty if the policyholder agrees to the terms. Correct answer A. Explanation. Failing to disclose a financial interest in a policy is a violation of Virginia law and may result in license suspension or other disciplinary action. Question 23. Which of the following is considered an unfair claims settlement practice under Virginia insurance law? A. Denying a claim without conducting a reasonable investigation. B. Offering a settlement that is lower than the policy limit when liability is uncertain. C. Requesting additional documentation from the insured to verify a claim. D. Settling a claim within the policy limits after a liability determination. Answer A. Explanation. Virginia insurance law prohibits unfair claims settlement practices, including denying claims without a reasonable investigation. Insurers must conduct a thorough investigation before making a decision on a claim. Options B, C, and D represent practices that may be part of a legitimate claims process. Question 24. Under Virginia law, which of the following is not a valid reason for an insurer to cancel a homeowner's insurance policy midterm? A. Non-payment of premium. B. Discovery of fraud or material misrepresentation. C. Increase in the insured property's market value. D. Significant change in the risk assumed by the insurer. Answer C. Explanation. Virginia law specifies that valid reasons for midterm cancellation include non-payment of premium, fraud, or material changes in risk. However, an increase in property value is not a valid reason to cancel a policy midterm. Question 25. Scenario-based. Emily owns a boutique in Richmond, Virginia, and her business insurance policy is set to renew in 2 weeks. Her insurer decides not to renew the policy and sends a non-renewal notice 12 days before the policy's expiration date. Under Virginia law, what action can Emily take? A. She must accept the non-renewal without dispute. B. She can file a complaint with the State Corporation Commission due to insufficient notice. C. She can demand a refund of all premiums paid in the last year. D. She can immediately switch to a different insurer without any legal action. Answer B. Explanation. Virginia law requires insurers to provide at least 30 days notice for non-renewals of commercial policies. Since the insurer provided only 12 days notice, Emily can file a complaint with the SEC for violating state law. Question 26. Which of the following statements about rebating under Virginia insurance law is true? A. Offering client lower premium than the insurer's filed rate is considered rebating. B. Rebating is allowed if both parties agree in writing. C. Giving client $25 gift card as token of appreciation is considered rebating. D. Rebating is strictly prohibited under all circumstances. Answer A. Explanation. Rebating occurs when an agent or insurer offers unauthorized financial inducements to clients to purchase policies, including offering low premiums than the insurer's filed rate. Small gifts of nominal value are generally allowed, making C incorrect. Question 27. Under Virginia law, which of the following types of insurers is considered a foreign? A. An insurer formed in Virginia but operating in other states. B. An insurer formed in another state but authorized to operate in Virginia. C. An insurer formed outside the United States. D. An insurer formed in Virginia and operating exclusively in Virginia. Answer B. Explanation. A foreign insurer is one that is incorporated in another state but is licensed to do business in Virginia. An alien insurer is one formed outside the US, making option C incorrect. Question 28. Which of the following is an example of material misrepresentation that can lead to policies cancellation in Virginia? A. An insured mistakenly providing an incorrect zip code. B. An insured failing to disclose prior bankruptcy when applying for coverage. C. An insured providing an outdated phone number. D. An insured omitting their middle name on the application. Answer B. Explanation. Material misrepresentation refers to false information provided by the policyholder that significantly affects the insurer's decision to issue policy. Failing to disclose prior bankruptcy is considered material because it directly impacts risk assessment. Minor errors, like incorrect phone numbers, are not material. Question 29. What is the primary purpose of the Virginia Insurance Information and Privacy Protection Act? A. To regulate the marketing practices of insurers. B. To establish guidelines for sharing personal information collected during the underwriting process. C. To mandate insurers provide refunds for cancelled policies. D. To ensure insurers process claims within a reasonable time frame. Answer B. Explanation. The Virginia Insurance Information and Privacy Protection Act sets rules for collecting, using, and sharing personal information by insurers. It aims to protect policyholders' privacy rights during the underwriting and claims processes. Question 30. In Virginia, which of the following is true about an agent's fiduciary responsibilities when handling client funds? A. Client funds must be deposited into the agent's personal account for safekeeping. B. Client funds must be kept in separate identifiable trust account. C. Agents are not required to account for premium payments. D. Agents can use client funds for personal business expenses if they intend to reimburse them later. Answer B. Explanation. Under Virginia law, insurance agents must handle client funds with fiduciary care by depositing them into a separate identifiable trust account. Misusing client funds is a serious violation and may result in license revocation.